Lesson 19.6 is talking about buying intangible assets and calculating amortization expense. This is very similar to doing plant assets, but you need to understand what an intangible asset is and how this might be just a little bit different. So if you look at the definition, an intangible asset is an asset that does not have physical substance. The way I try and explain it, intangible assets are not things that you can physically hold, touch, feel. The examples they give are patents, copyrights, trademarks, things like that that you actually own a piece of paper that tells you you have rights to something. For instance, a trademark. When you think of Walmart, you think of the little smiley face. Or when you think of McDonald's, you think of the golden arches. Those are the trademarks. And if you own that trademark, you own the rights to use it, and nobody else can use it. A patent is something that you own when you have created a product. So you have rights to that once you have created a particular product. In the book, it will tell you that patents are granted for 20 years. So they have a life of 20 years. Copyrights are a little bit different. Copyrights protect printed material, and I looked it up on here to find out because I thought I knew but wanted to double check. A copyright, by general rule, if it was created after January 1st, 1978, the actual piece, like for instance a book or a publication, if it was created after January 1st, 1978, the protection lasts for the life of the author plus 70 years. So if the author dies in the year 2000, the copyright is good through the year 2070, the work that that author created, 70 years past the author's death. Now, if we have anonymous work or pseudo-anonymous work, we don't know who did it, not identified by a name, then the copyright is for a term of 95 years from the year of its first publication, or a term of 120 years from the year of its creation. So just some things to think about when you're looking at borrowing information, so to speak, from other things. People worked hard, they got these things published, they developed these things, they've gotten patents, and they have rights and they're protected by law. So you need to understand what some of those laws are. Okay. Now the value of the asset comes from the rights that gives the patent holder the right to it, not just the piece of paper. So when they buy a patent, a business buys a patent or a copyright, they really are buying an asset and the right to do it. So they're going to pay cash for it most likely, so they're going to credit cash. They're going to debit the asset. If I'm buying a patent, I'm going to have an asset account called patent. I'm going to debit that account. If I'm buying copyrights, I'm going to have an asset account called copyright. So this entry here where it says paid cash for a patent, $45,000, I'm in my cash payments journal. I'm going to debit the asset and credit cash. Now, $45,000, you might not think in a business that's a lot of money, but that's a lot to invest in an asset and not have anything to offset it, like I do when I buy a car and I can depreciate it, or I buy some other plant assets and I can depreciate it. Well, you have an option called amortization. This spreads out the cost of an intangible asset over its useful life. So instead of depreciating an intangible asset, you amortize an intangible asset. Now notice it says over its useful life. It does not say the life or what the law says. So for instance, a patent might be good for 20 years, but its useful life might only be good for 10 or 15. It can differentiate from what the law says the piece of paper is good for. So always make sure you read your directions on these. Okay, they have a legal life and they have a useful life. Okay, so for instance, in this case, and this is the example out of your book as well, I do believe, the original cost of that patent was $45,000. It's not going to be worth anything when it's done, because once a patent runs out, there's no salvage value. So we could expense out $45,000. Now we're determining, instead of 20 years, this patent is probably going to be good for 10 years. So over the course of 10 years, I get to amortize it out for $45,000 a year. This is my annual amortization expense that I get to write off. Okay, so I figure up what I'm going to write off for the total divided by the useful life and get an annual expense. It's not depreciation, it's amortization. And I do just that. I do an adjusting entry. I debit the expense account. I credit the asset. There's no accumulative in this. It is just simply crediting the asset, because when it's all said and done, I can't resell this patent. It's only good from the date it was issued till the end. It's only good for the legal life. I can't resell it. Just like a copyright, I can't resell it at the end of its legal life. So when I record this entry, I debit the expense, I credit the asset directly. Debit amortization expense, credit patent for the $4,500 that I get to write it off every year. Okay? Now, this is the last section in Chapter 19. When you come to class next, you're going to work on the 19.6 work together on your own and be able to ask questions. So make sure you take the time to watch